Cool. All right. Good morning, good afternoon, good evening, depending on time zone where you're joining from. Welcome to our weekly Saturday discussion all around investing. The topic that I want to talk about today, I think there are two main topics. One is definitely I want to go through some learnings from the mistakes of the great investors. You know, these are the investors that we admire, not just, I mean, the whole investing community admire. And this is basically a summary of learnings from the book Big Mistakes. And I would rather learn from the mistakes of other than learn from my committing the mistakes and hurting my own portfolio. Though everyone will pay tuition fee to the market, no one has escaped the tuition fee, but we'll try to avoid as much as possible. So learn some lessons from it. Go through that. I'll also want to share, I think last week, Aditya, you had asked for in terms of what kind of a portfolio metrics. So yes, I plan to do, the end of a year review for my own sake. And I will share in terms of what kind of a metrics do I plan to track, and maybe we can go back and forth on see what else should we track, right? Because I'm a stickler for if you don't if you can't measure, you really don't know where you'll end up and where you're going. So
Yeah,
measuring your performance is important, right? And I'm not saying compare with X, Y, Z or any other person, but you should know what and how you are doing, right? Then you can make an intelligent decision. So I will want to share some of the metrics that I track, and maybe we can come up with a comprehensive list.
yeah,
So those are the main things. Of course, we'll look at briefly what happened in the market, and yes, I also want to cover one of the topic that I told last week. We'll start a discussion with is skill versus luck. So here's the homework for you all. Pick up one stock in your portfolio that have done good for you, in which you think it was because of your skill, and then one stock in which you think you got lucky, right? And this may not be completely black or white. It could be fall somewhere in the middle of a spectrum, saying, "Hey, I thought I had a skill in identifying this company or this stock, but gosh, I think I got lucky because this has become like 10x, 20x, which is out of my wildest imaginations." So either way, uh, be ready with the one stock in which you feel you had skill involved, one stock in which feel you got lucky. So we'll discuss that. That's on the agenda today, and then we'll open it for breakout rooms. We'll have whatever open discussion on anything else that you want to talk through. Jay is not here. Jay generally has a great charts to share during the breakout rooms. So that's one room which is very, very populated. Okay, anything else you want to talk about? I'm also taking it a little easy. Is that it? Sounds good. All right, so let's get started. As always, everything that we discuss here is only for education. So don't go and trade based on solely on what you hear. So let's start with skill versus luck, right? And especially as an investor, it is especially in investing, it's not always easy to identify the skill or luck. There are some areas where it is very easily known whether it is skill or luck. Chess is one game which is purely skill, right? And I was surprised to see this comment from Michael Mauboussin, which says there's a quick and easy way to test whether an activity involves skill. Ask yourself whether you can lose on purpose. I mean, what? If it's not that you can win on purpose, but ask yourself if you can lose on purpose. For example, chess is skill, because if a master chess player can lose on purpose to anyone, right? Whereas lottery is pure luck, right? Even though we may pick any number, there may be a slight small probability that may get lucky, I'll still win. I can't, if I'm picking lottery ticket, I can't lose on purpose, right? So that determines, whether it is skill or luck. Another example comes in. So investing falls somewhere between pure skill and pure luck, because in the short term, there is so much noise in the system. We have no idea whether it is because of our own skill or because of our own luck. And later on, when we'll review the mistakes of some great investors, one of the big mistake is people or investors, they mistook luck for skill, right? And we generally see that happening in the bull runs. We saw that happening in 2021, um, probably in 1999, wherein everything, you invest in just becomes gold. And we thought, oh gosh, we all are great investors. 2021, everyone, when they get up in the morning and look into the mirror, they are seeing Warren Buffett, right? But so during the bull run, it is very easy to confuse. So, especially over a short period of time, it is much more matter of a luck than skill. So the question that I have is, can you lose it on purpose in the market? Right? It might seem probably easy. Come on, I can lose it. I can pick some bad, worse companies in the market, penny stocks, companies with no revenues, etc., and probably can underperform, and I can lose. So there is actually an experiment done on this, and let me know, just share that with. It was asked 71 on associates to pick 10 stocks that would underperform the market in the second quarter. Only 19 of them succeeded. So 73% tried to lose on purpose, and they couldn't. So short term, it's a lot more function of luck than skill. So even if you want to lose on purpose, you might have picked some meme coin, but that meme coin could become 100x. Who knows? You could still not lose on purpose. So that's why investing short term, it's a lot more of a luck. And then if you're evaluating any fund manager or financial advisor, that's why it's said, right? Look at a long-term performance. Don't look at the screenshots that are floating around where the account started from January 2023. Starting from January 2023, even a monkey will succeed in the market. Really need to see how the same people performed during the bear markets. That's where the real differentiation will come out. Anyway, so getting back to it, wants to share one stock in which you think you had a skill involved. Share the stock and what do you feel? When did you buy that stock? Anyone? Seeking volunteers. Who want to talk about a stock in your portfolio which you think you had a skill involved in it in identifying the stock?
Vivek,
Yeah.
I believe it was CNBC. Before the TikTok announcement, they said Oracle is negative cash flow next year, but Broadcom is like 20 times next year's cash, a very positive cash flow. So, any thoughts on that? I mean, I'm sure their figures are right, but so what they were saying, Oracle was vastly overvalued, and Broadcom was was adequately valued, or maybe even less so. Any
No,
thoughts on
so
that?
so so they are looking at one part where it's called cash, which is based on cash flow, and we know why Oracle's cash flow are basically will be constrained is because of their investments in in the data centers, right? So that's why they're gonna get into cash flow negative. That's why they're raising debt. Whereas on a Broadcom, they are cash flow positive. They generate good amount of cash flow, but the concerns on the Broadcom is a margin compression, right? So overvalued, undervalued, I don't know. I've not looked at any of those companies, but if you're evaluating from an investment perspective, think through in terms of your valuation criteria, right? Some companies may be just cash flow positive, but you might have to dig deeper and say how they are cash flow positive. Is it that they are, not investing in future growth, or is it that they've already, they have done their investments and still have a lot of amount of cash left in it? So I have no comments on both either Oracle or Broadcom. I don't own any. I was thinking maybe Oracle may be a good buy at this point of a time. Especially after it is down what 30% at sector or more than 30%, right? From its jump after, I guess that was Q2 earnings, right? It was up like 30% after Q2 earnings. But yeah. So you'll have to double click and see what, um, how you want to analyze with the data that CNBC is providing. Would you short Oracle at current levels, more downside? I don't generally want to short a company direct do a short stock. I generally don't short a company as a principle. If I really want to do it, maybe I'll sell a call spread. Maybe I'll buy a put or a put spread. That's a second preference, but I don't sell naked shorts. I've seen many so-called great investors losing because they became too cocky and sold the company short, even though it's a crappy company. But markets can stay rational longer than your portfolio can stay solvent. So I just don't want to take that risk. There are many other ways to make money, right? Why you want to go and try such a tougher route to make money? So I won't short it. Not because not because of the prospect of the company, just because I think that's a game I don't want to play. There are people who love to play that game. Where successful short sellers are there. I just don't want to play that game. So I won't short Oracle. I mean, for that matter, I won't even short Palantir. I mean, if I have a stock, maybe I'll sell a call against that. Maybe if I do delta reduction, I'll do a call spread, but I won't naked short Oracle or Palantir or for that matter any stock. Oh, look at Oracle. Now it gave up all that bump back to where it was. Okay, coming back to skill versus luck. Anyone wants to share any stock where the skill was involved? It's not an easy game if running through a portfolio. Is it not easy to identify? Or we'll come back to this question later? What do you say? Come on. Niyanka says Palantir. So yeah, so what is it? Skill involved or was it luck? Want to talk about it, Niyanka?
So it's just the luck, right? You talk about it. I like the company at that time and invested some, and it just went drastically upwards, right? So I know the number, it doesn't make sense, but it's keep going up. So it's just luck. I feel it's luck.
Yeah. I think if we are looking at a stock and our reaction is, gosh, I want to buy because this sucker keeps going up, that means it's just luck. Yeah. It's still it's some luck, some skill and some luck combined. Yeah, I Yeah, I think there are very few stocks, unless you're just buying it because you heard it from your friend, which, or, you just read it somewhere and you didn't do your own due diligence, then it is like, yeah, you just got lucky, right? So I don't think I'll have any stocks which are like pure luck. because I've spent time in trying to understand it. But there are some stocks for me. Palantir also I put in the luck bucket. It is because hey, it's $7. It was a skill. After $60, $65, it's all luck. Yeah, beyond that, there is no skill involved in investing in Palantir. So we were call it lucky because we already studied the company, knew what the company does, etc. So when the opportunity came, when the stock was in single digits, yes, that was a skill. Now it's all luck. Uh, Sridhar, I buy think I use skills, and I always like that defines the outcomes. Even if the outcome is negative.
Yes.
I don't know. Short term, yes, maybe short term the outcomes are, but then are we running into, I forgot what's that cognitive bias is, which is, yeah, all the success is because of my skill and all the failures is because of bad luck. But you are saying even the good, even the successes and the failures both are because of luck?
I know. Sometimes I feel like that. Just probably just me.
Sure. Any stock you want to talk about?
Um, the Corby one, it
Mm-hmm.
just jumped up, and yeah, that one I never thought it'll go up. Uh,
So you got lucky in Corby.
yeah, that's what I would say.
Okay. Okay, so those who are investing in any of these, little digressing from it because I was something I want to share. Um, those are invested in any of these neo clouds, so-called neo clouds, CoreWeave, Nebius, Iran, and I know Jim Chanos, he's short on Iran. He was recently on one podcast. That podcast is not on my regular podcast, but he showed up on YouTube. Just search for Jim Chanos, maybe plus Iron plus Corvi, probably it will show up. Uh, Listen to the podcast in terms of the thinking of I like the thinking process of Jim Chanos in terms of thinking about the business fundamentals of these data centers, right now all these AI data centers or the companies that are basically, these are kind of a REITs, right, who are providing a data center space for AI companies or hyperscalers to use. Um, the business model that and the mechanics of how those companies should be valued is very different than what the market is currently valuing it. So go and just listen to that if you're invested in any of these neo clouds, right? With a disclaimer that Jim Chernoff is short, so he will probably won't have any favorable comments for it. But I think I really like the thought process of of his analysis. And by the way, I've said it multiple times. I like the short sellers analysis a lot more than the long analysis, because they do a lot more in-depth analysis of a company than the long ones. Yeah. Kevin is a skill and luck are only two dimensions. Third is emotion. I think for me, emotion is number one, right? Because that's why I spend so much time on personal side of investing, because I realized earlier my investing cycle is, it's easy. It's not that difficult to pick a good company, because you hear it from the good investors, either CNBCs or SON conference. Look at, you can identify, looking at how the world around you is changing, and identify what companies probably are gonna survive or will be relevant 10, 15 years and gonna grow their market. The worst, the worst thing which I have found is staying with, once you have the shares, holding on to the shares for the long term, which is nothing but just an emotional game. So, and that's way more difficult than identifying or doing all the IQ related work, right? So that's why I generally say investing is more EQ than IQ. Kevin, well said. They are just REITs collecting rent. Everyone wants to collect rent. Yeah, but they are not only AI companies, right? Aditya, I lost patience with Intel. Yeah, and now Intel. I mean, I don't know what's the size of a portfolio on Intel because Intel is a turnaround story. So if your sizing is as per, it should be for a turnaround story, you can still play the game. I mean, I'm still holding my Intel shares, even though they are underwater. But it's a turnaround story, strategic. It's just like a Boeing play for me. It's strategically important for us, so probably won't go bankrupt. So, but even if it goes bankrupt, it's a small part of a portfolio. So, who cares? Yeah, Sri, go ahead.
Yeah, I don't know about luck or um, my intuition or whatever it is. I've been doing this trading for a long time. I'm I'm very poor at picking the stocks. I listen to other people and try to say, okay, I'm willing to take a chance with that. And I do options and basically let the market decide what it wants to do. If it wants to come down and give it to me, I'll hold on to that particular stock for quite some time. If it goes against me, I'll be willing to stay short for some time and try to adjust that by selling the puts and doing the opposite side of the trade that I have. And I have been successful doing that for a long time.
Yeah, so
You tell me whether I'm lucky or I'm skilled in picking those stocks.
So I think to me, it looks like the skill is in the process that you're following, right? And not per individual stock. You probably do it for multiple stocks that you have in your portfolio.
That's right.
And the skill is I have identified the process that works for me, and I'm gonna stick to that process. And I'm not gonna get swayed by someone else who is saying, oh, maybe do this kind of a trade, do that kind of a trade. Works for you? Great. Good luck. Live with it. For me, this is what I've identified that works for me, and I'm gonna stick with it. And you become very skillful in following that and not deviating from what has worked for you. I think that's a matter of skill. Now within that process, sometimes does some of the trades goes against you, sure. But then that's where the skill lies. Yeah, I'm not gonna just change because of what or because of a few trades which I've lost. As long as you follow the right process, outcome could be different. Outcome, I think someone said, right? Outcome always, Sridhar was saying, outcome always involves some sort of a luck. But I guess identifying what works for you and sticking to that's great. Kevin, you're skilled in riding the waves. Option surfer. Mike is saying there's a mathematical formula for determining if an active man is skillful or lucky. It is only determined after 16 quarters. So, so if it has 16 quarters, I think to me it seems like a very small period. Because 16 quarters, then I can call myself I'm skillful of beating my benchmark index. But I think it's still a small period. 4 years. What is 4 years in investing journey? But yeah, is Wall Street doesn't have a long-term horizon. So for them, maybe 16 quarters probably is good enough. All right. Anything else? Rajiv says got lucky in BMNR. Are you still lucky in BMNR?
No, I got out of it,
Okay. So,
luckily.
so, so lucky
Yeah,
was to enter and get out.
yes, I was lucky to get out in the triple digits.
Oh, okay. Yeah, you did say, okay, got out before they crashed. Yeah, okay. Yeah. Oh, you got out at triple digits. So that's been very lucky. And Goog felt undervalued at 150 when I got in. That's good. Yeah, Google. I think some of the stocks that I hold in portfolio, where I think I got some skill involved, and majority of the time when I'm trying to identify it is I consider it a skill involved when I'm going against the grain. Right? When the market is saying, oh, this is not happening, and you're still thinking, why is market saying like that? Like Google was one such stock. Alibaba was one such stock in 2023, where it is available as at such a cheap valuation. Jumia is one such stock, even though it has got roller coaster ride. But if you look at quarter by quarter, I'm like, yeah, they are changing, and maybe it will take market for to catch up in terms of what's happening with them, with the stocks. These are few stocks which I realized I had some skill involved in it, because no one else was holding a similar opinion. It was like contrary to the market opinion. I was holding the opinion which was contrary to the popular one. Palantir, I got lucky. I initially started with skill, then I got lucky. Which one I would say? I think TSM, and these are probably consensus trades. Microsoft is consensus trade. Meta, buying little bit of a Meta in 2022, I think at $100. Probably some skill involved, or maybe call it got lucky because I got a put assigned to me. And then I thought, okay, anyway, got it assigned, so I sold some, kept some. Probably if the put did not have get assigned, maybe I wouldn't have bought it. I don't know, call it luck or skill. But yeah, it's a good exercise. All right, Aditya, are there position sizing best practices that people use? I do have my sizing, but I don't think there's anything which is um, set in stone. Well, it depends on, for me, it is based on what helps me sleep well. That's my overarching motive when I determine my position size. I really don't care about, some people say 15%, 25%. For me, it's a sleep factor. So basically you can determine what should be, but I am a fan of at least having 15, 25 tickers in our portfolio, right? To diversify. And I know some study shows that more than six takers in your portfolio give you enough diversification. After that, the effect of diversification, the benefits of diversification has a diminishing returns. I don't care. I want to have at least 25 stocks in takers in my portfolio, including stocks, ETFs, and all that stuff. Sridhar, I'm just trying to be disciplined, stay in regardless of outcome. Yeah, I think again, coming back again and again, discipline is most important. Okay, talking about the market, we had an inflation, surprise inflation came out to be lower than what the market was expecting, but I don't know, should we even believe these numbers? Because looks like some of the numbers were not even considered, like 0% housing inflation in October due to missing data. So I'm like, whatever. Who cares? We don't even have a numbers, and then because of that, the inflation numbers came down. So I don't even know what to do with it. So let's skip it, because this was I know on Friday market was higher for whatever reason, but yeah, I just don't put too much emphasis on this inflation number. Yeah, Sam, go ahead. You have a question?
Yeah. Friday, Okay, I came out with my first um what do you call that, call earnings. I'm gonna earn like $5,000 from it on Alibaba. But I asked the lady if I had bought 100 shares at 85, because I keep a some amount of money in my account. Back then it was 200,000. Well, we didn't know if Alibaba a year ago was going to go up or not. So was it safer that I bought calls, or should I have bought the stock at 85 and it's being exercised at 90 yesterday?
So
Because I
depending on, so between calls, buying calls and the stocks, my thesis is still the same. If you're buying calls, if you buy out of a money call, depending on what delta calls you're buying, I'm not a big fan of buying out of a money calls, because if you buy out of a money calls, then you want stock really has to work hard to go up. So really need to have a very good conviction that the stock will move in your favor, because you are paying whatever price you paid for the call is all extrinsic value, is gonna disappear. uh, I bought calls, but those are generally deep in the money. It is because I want to use as a cheaper substitute for better capital usage. So I don't know what call you bought, but if I were in your position, either I would have bought the share, or I would have sold a put, or I would have bought an, let's say, 80 delta call, right? So that's what I would have done. Now,
so I think the stock was probably at 89, and then I just bought it, or 91. Well, it was barely out of the money.
yeah,
So
not
then I
too.
just bought the call.
Yeah, it's not too much out of the money. If the stock is 89 and about 91, that's still okay. It's around 40, close to 50 delta call. But remember, whatever premium you paid is gonna get decayed. So you need to really know, what's the duration, how long the duration of days to expiration it is, etc. So uh, I I prefer buying it if I'm doing a stock substitution trade.
Vivek, China has been known to close their market leaders. They do that occasionally, and we back then we were not sure Alibaba would come back or not.
Yeah, yeah. That risk is always there. I still have overall my China-based portfolio within the my position limit for China. So that is irrespective of whether you want to buy the call or not. So if you bought some auto money call, you're trying to get lucky. It's a lottery ticket, works out great. Otherwise, hey, I only lost whatever the money that I put in buying that premium, right? Yeah, you can play this game once or a while. You can't run a business buying lottery tickets. All right. Looking at the market, we are start to see some rotations happening, right? And shouldn't be surprised, because in November we saw market correcting, especially around the bigger tech companies. They were correcting because now the also market is moving to other sectors. Still, the Nasdaq is trading at a higher forward P ratio than this 10-year average. There are still some sectors which are not that highly valued, right? So, and we have it is good to see that the market is now broadened, right? Because one of the big concerns that economists or what market commentators have about the market is that it is too concentrated. It is driven by only top max. I mean, not the case anymore. It's good to see that the market is now starting to broaden out. We are also seeing a cyclical sector, mid cap, etc. Now they are coming back to their average valuations, right? And hopefully, what I also read somewhere was even the earnings growth, the forecast for the 2026 is also broadening out, and they're looking more positive even for those non-tech companies, etc. So which is good in a long term. So I'm still hopeful around 2026. Will there be companies? Again, it depends on what happens to the whole AI theme. So far, all this GDP growth is largely driven by the investments due to AI theme, which makes me a little concerned. Uh, but we'll see. So, and that AI, this is a, I think the challenge currently which we are facing is even if you go outside the tech, so-called tech companies, you're trying to identify another company and say, you know what, I'm going to invest in this HVAC company or this electrical components company or this materials company. I think now what we have to do is do an answer why this company is now going higher, why the revenue is going higher. If it is all tied to the same theme as the AI theme, essentially we are betting on the same you know I would say same factor, which is AI. If you already have enough stocks which are driven by AI or largely dependent on how the AI, where the AI wind moves, do you really want to have one more stock in your portfolio? That's a decision that you have to make. I become very conscious of looking at it. Do I want to add more, uh, which is related to AI or not? Do I have enough of AI related stocks? I do want to add something more in my portfolio which is non AI related, right? Which is not going up because there is an AI tailwinds behind it. So I want to have that diversification. I don't know, what do you call it? Theme diversification, whatever, in my portfolio. Because if you look at my portfolio, my top holdings are still like all are driven by AI. But you gotta, except the first one, which is Mercado Libre. I'm like, the number two is Google. Then you got a Meta, Amazon's, and the QQQs. They're all AI ones. So I'm like, I don't want to add Eaton, or I don't want to add, G Vernova. This is a great company. These are not Nasdaq or not the tech companies, but these are, you can call it as, on industrial companies, right? But then I'm looking at it, these are called industrial companies, but are all driven by the same AI theme. Do you really want to add it or not? You have to decide for yourself. Now we are, so when we see that the with the here in the market that it is broadening, because now you see materials going up, industrial sector going up, energy sector going up. And if you hear the market commentator saying, the rally is broadening, I would like to take a pause and say, is it really broadening? Sector wise, it is broadening. Thematic wise, is it really broadening? And do I want to play with it? So now, I'm not saying anything is right or wrong, but you might want to evaluate for where your comfort lies. Okay? And maybe I want to play this team. I want to go. I'm a Stan Druckenmiller. When I see I shouldn't say bubble because we never know it's a bubble, but Stan has said, right? If I see a bubble growing, I want to run into it. Right? I don't know. So, uh, so even though the chart says it's broadening, you really need to go one level below to figure out what broadening means. So Kevin has a big question. Kevin, you want to talk through it? I don't know. Is it for me or was it this for Aditya? Premise of the talks: growth investing, value investing.
Yeah, it's for you.
For me, every investing is, I think, value investing. Growth is part of value. I just don't want to classify or differentiate between growth versus value. So I know this goes. I mean, traditionally, fund managers do classify themselves as, I'm a growth investor or I'm a value investor, means I'm gonna buy low PE companies. But over years, I think every investing is value investing. Eventually, I'm buying the shares which or buying the company businesses which I feel will become more valuable later. right? Now, so I consider myself as a rational investor, and from me, every investing is value investing. It could be at a higher P, I don't care, because some of the businesses will grow. Traditional value investors, you would know, Benjamin Graham is, hey, I'm gonna buy the companies which I think the valuation is 100, and currently they are trading at 80. I'm gonna buy that company, and when it becomes 100, I'm gonna sell it. Do I have such companies? Yes. But growth investor is gonna buy the company at 100 today because they think in the future that could be 120 or 130. Right? Do I have some companies that I own like this today in my portfolio? Of course. But that's a traditional definition. And if I'm a growth investor, then once it reaches your whatever 130, are you going to sell it? No, I'm going to look at it. If it continues to grow, I'll hold it. So I just don't, me personally, I don't want to box myself into value or growth investing. I think every investing is just value investing. You want to pay less for what the company will be worth or valuable in future. So that's my thought process. Day trading, momentum scalping, I don't do it. I don't do, not for the with the intent of momentum chasing or gamma scalping or day scalping. Have I done one or two trades sometimes? Sure, but that will be like one out of 800 or 1,000 trades that I've done for the year, right? But no, I don't do it. My thought process is great companies reduce cost basis and just ride the wave. Right now, reducing risk in portfolio or cost basis is where options come in picture. Mike say I see GARP, MU, Avgo, AMD, Nvidia, all are AI players. Sorry, was there another question?
No, I was just commenting that today, based on my, I have a Python tool which scripts and determines, and these have unusually good, I guess, undervaluation relative to the broad market, I guess. And no matter that you think they are part of AI world, that's how their growth prospects are, and that's why they are undervalued relative to their growth prospects. So yeah, Nvidia has become surprisingly more attractive in the last 4 weeks
Yeah,
relative to these
Nvidia.
numbers.
Yeah, Nvidia
So
became more. Nvidia became cheaper after their stock price went higher in 2024, I guess.
no, but I'm talking about last 4 weeks. So I
Even
run
now,
my
also,
tool
yeah.
every 4 weeks, every day, in fact. What I'm commenting to myself is Nvidia's perceived undervaluation has increased in the last 3, 4 weeks. So in other words, not only has, I guess, its price come down as you've seen in the last few weeks on Nvidia, but also the analyst estimates on the growth have increased in the last 4 weeks. So anyway, that's my.
Yeah, so Nvidia is not it's not super expensive. So when someone says is Nvidia then not is an next Cisco, not currently.
But the key is that every day these analysts are revising their consensus estimates. And if when somebody can actually write a tool or whatever to find those changes, you can actually effectively front run the pricing moves.
I don't know. I used to track analyst report, but I've stopped doing it because many a times I see that they are just chasing the prices.
No. Have
You,
you, okay, so have you visualized what these analysts' day job is? They're sitting at this desk. They have a very extensive Excel model based on like what you do, DCF, and discounted cash flow analysis. Every day they are charged with attending to that model simply. And basically any changes they perceive through the channel checks or whatnot must go in there. And that's how they come up with the number.
yeah, and I don't know who said it, right? All models are wrong, some are useful. Anyway, I think this is a never ending
That's how, like in
discussion.
the 1920s, they used to say there are no statistics. There's just damn lies, and there are lies, and then
No,
there
no.
are
I mean,
statistics.
my concern is
And the world has changed so much that neural networks, which absolutely use statistics, are so accurate that people actually running towards them.
no, my only gripe around the whole analyst community is because I've seen personally gone through the experience after I started looking at individual stocks and owning it for a few years is if the stock price falls down for 10-15% because something happened in the market, right? I would start to see that the analysts, reducing the price targets, and I'm looking at there's nothing changed in the business yet. Maybe the other one has changed. What additional information are you talking about it, right? And then if the stock price goes up, they'll start to chase again. So I'm like, oh, you know what? I don't have to chase these analysts. I need to come up with my own thesis around do I, how the company is doing, etc., and then build my own conviction. Because there are many
That's
stocks I
one
hold in my
perspective.
portfolio that analysts have downgraded it and say, oh, it's bad, it's nothing gonna happen. China is uninvestable 2023 because Chinese
Right.
equities were down. You know, when the Chinese equities started to go up, China became investable again. Nothing changed in the
Okay,
Chinese government between that period.
so I hear your perspective. So I gather you're basically a pure fundamental person, and that's what I was, and people who are schooled in financial education are trained to be, which is just don't look at the charts or technicals. So I bet you don't look at technicals. The philosophy that I'm talking about is when you're trying to kind of peek ahead at what the analysts and estimates is the thesis that actually the market as a whole is uh, its undercurrents is what you want to divine upfront. So that's what the thesis of technicals is, right? You look for MACD crossovers, which means
Mm.
you're saying the market is saying, hey, money is moving in here. So no matter what is driving that change, you go in.
Yeah, I do look at some technicals, but that's not my. That's
There
only
you
if I
go. That's the
went to
reason.
initiate a position. That doesn't drive my thesis around the company.
I've
And
reluctantly in
also,
the last 2 years come to recognize that my failure in decades was because I ignored the technicals. That's why I stayed out of the S&P 500 from 2016 to 2019. Because
Oh my
from
gosh, we're coming from opposite spectrum. And
yeah,
I think I thought, gosh, I should have focused more on the companies and businesses to start with. I would have done much better. Anyway, this is why it's fun, right? Stick to whatever works. So I'm sticking to, hey, this worked for me. I'm gonna stay with this. And if technicals are working for you, great.
no,
Uh,
it is the same way like the Fed is adjusting the interest rate after the market has already paved the way, and then they catch up. The market analysts are the same way also to a great extent. When the market goes down, they say, okay, it's time for us to go down. It's time to bring the prices down
yeah.
and things like that.
And because sometimes they have a career risk, right? So let's say if the stock is trading at $100, again we're digressing, we'll come back to it. Stock is, but it's an interesting discussion. Stock is trading at $100 in the market, and analysts at the $100 price, right? Now the stock is at 80. If the analysts if they don't downgrade it, or how do you explain to your clients that you should buy more or you should buy more, right? Either you go and tell your clients that say you should buy more, or other thing is you downgrade the stock. So unfortunately, we don't have a career risk. We can make independent decisions. When analyst is given the rating, there's a lot more stuff involved than just business decision. Very few analysts will put a sell rating. Why? I mean, if you can go back and look at it, there was some study done like 75, more than 75, 80% ratings are all buy ratings. Why? Because if they put a sell rating, they'll start to lose access to getting invited to investor conference and talking to management or doing. So I don't know. It's not purely based on the business fundamentals. They might, and sometimes they'll say it is underweight, right? It is moderate buy. What do you even mean by moderate buy as a rating? It's a soft buy, hard. I don't know. I mean, soft buy means what? I should buy when I press the buy button, I should press the button softly? Are you trying to tell me that I should sell the stock or not add without actually using the word sell? So, because they have a career risk, that could, I'm not saying that, I mean, don't, they're not lying, but that could cloud in terms of how they're presenting the data. And that's my, and I've seen, especially on the stock that I own, ratings coming back and forth, and stock goes high, the analyst ratings will go high, they'll immediately jump up the price target. And let's say if you like the company, nothing has changed in the company, stock has gone down by 20%, you should be buying hand over fist. And not saying, okay, hold on to it. Why? So that's a concern I have, and this is purely based on what I've seen happening to the stocks that I own in my portfolio. It's not a generic comment. Maybe I own the stocks which are in which analysts that follows are not the best analysts. Who knows? Okay. And I talked about Jumi earlier, right? I used to jump into earnings call. Not even single analyst will be on the earnings call. Not even one. Yeah, not it's this company is not being, it doesn't get followed on the Wall Street watch. But the moment stock price started to go up, now I see some analysts come. Now there's a price target which is coming at $18. Right? And the same Wall Street was sitting on the company when stock was down to at $2. They say, oh, it's a bad stock to buy. Come on. If there's nothing had changed in the trajectory of the business for one quarter, you had uh, the company didn't perform for that particular quarter, you should be adding to your portfolio if the long term is still intact. Why did you downgrade the company after it has fallen down to $2? And I bought at $2. Now it is 12, I don't know. I think now it is $13 or something. Now they're coming with the price targets of $18. I don't know where you guys were in May, etc. So that is like, again, this is never ending discussion. I used to read through Barron's and their recommendations and all that, and start following it after I saw a report from Barron's where they compare their recommendations and how the stocks did. It's like a 50-50. I think it's 2022. They had like year end, they had the comparison. I'm like, guys, if you are like a coin toss, then what's the point? Right. So anyway, this is my personal experience. So I don't blindly follow it, but I do look at it in terms of the growth projections. I look at the analyst number in terms of what they're expecting in terms of the revenue growth or EPS growth, but I'm not gonna follow the recommendations of buy or sell or the price targets. That I'll determine myself. Again, that's just me. And now we got some 2026 outlooks from banks. Again, this is one another classic example of S&P outlook, which Wall Street will put up at the end of every year. And it's all over generally it's all over the place. I don't know. I have not looked at, I think I do have a chart here, which talks about the Wall Street analyst, the estimates. But remember during the whatever, the Liberation Week, Goldman Sachs, they used to change their year-end estimate like every week. Guys, just say that situation is fluid and we can't give you estimate. What's the point of freaking estimate which you keep changing every week? How is anyone gonna make any investing decision based on your estimate which are gonna change the next week? Because the situation was fluid, right? Donald Trump says something, Goldman Sachs will come and update their estimates for year-end S&P 500. I don't even know where they eventually ended up in, but it was so frustrating to see. Can you guys not just keep quiet? Why you have to put in there are some career risk involved and all other stuff, which I think at least you and I, we don't have to worry about. And that's my thought process. But I do want to read the reports in terms of the business, find out how they are doing, but the decision of buy or sell has to be with me. All right, coming back to the markets, in 2025, we had 336 IPOs as of December 17th, which is way better than what we had in 2024. 2024 was almost a dead market. This is not still, I thought 2025 will have more IPOs, but probably not. The market is still not opened up yet. But the notable IPOs were CoreWeave, Circle, Figma, Klarna, Chime, Fermi. Which one did I miss? Any other big IPOs in 2025? These are some of the ones that we have talked about. Any other you guys anyone invested in any IPOs? And I think we recently had Medline, right? So it's like a 70-year-old company. It recently went IPO this week. PE firm brought it back to the markets. I'm not a big fan of investing during IPOs. Ravi says Klarna. How did that work out? I don't know. I don't own Klarna. Oops. Well, at one point, because of chance, they will be right. Okay, so that's our analyst. Yeah. Chintan says it got IPO at Figma. Okay, so yeah, Jesus, $32. None of the companies post I shouldn't say none, because we only looked at tools. CoreWeave. Okay, CoreWeave is still better from their opening price, not as too good. I mean, that was the initial run up with an excitement, and then we see it coming back to earth. What else? We got Circle, crypto stuff. Not much doing back to where it was in an IPO. So if you miss the IPO train, there are a lot of stocks that are available at cheaper than where they were from IPO side. For me is, I think, isn't this
I generally look at IPOs almost 6 to 8 months after the IPO, because IPO initially they are super hyped. And look at Figma. From 33, it went up to like 100 and something, and then it came back down to like 40s, right? Less than 30 right now.
Yeah.
Less than 40 right now. So
I want to at least give a year for companies to come to the market, show me their performance for at least 4 quarters. And before I even decide to, do I want to put my money in them or not? And you're absolutely right, because IPO time, and I've been through this process of company IPO. So an IPO time is wherein management wants to clean up all the numbers, make sure we put up the best face in front of investors, and we have a very little advantage when it comes to IPO. They are hyped up to the best. If there are any negatives, we'll probably shove it in the bag. We'll deal with it later, and then 6 months down the line, you start to have those lockup period will start to expire. A lot more shares will come in the market, and so unless you are like, I don't even know in what condition should you invest in. Unless we become greedy, saying, "Oh gosh, this company is gonna continue to go up and up, and I want to get in now." I guess we could all do ourselves a lot good if we can wait for the company to show us that they can perform in public market. Fermi, FRM, isn't Fermi a nuclear energy? Ravi, is that the company? Oh, okay. Okay. Yeah, nuclear energy. What else went public? I think Navan was another AI related stuff. Yeah, that much. I think Medline has done well. I shouldn't say done well. On the day after IPO, it has done well. We'll get to see what happens later. 2026, probably big one. We gotta get SpaceX. At least one company has put on they put on feelers that they're gonna go IPO in 2026. Maybe $800 billion. There are talks around maybe it'll open up at $1.5 trillion. That'll be an interesting one. It's gonna reinvigorate the IPO market. I mean, we haven't had, even though we had close to 336, what we got another week to go. Maybe we'll get to max 370, 375. Not that big an IPO year, this one. So maybe 2026, we'll see.
Vivek, check out MCTA, Charming Medical Limited. It is up by 633%. MCTA.
OTA,
Right.
farming, $2. Like that, I think there was some other, there is a chip company or China like up around 600% on a day. Right. I don't know what does this with Charming Media MCTA?
It's a medical company.
Yeah. It's a biotech. They provide a wellness and postpartum services brand name in Hong Kong. So I get a little wary about a lot of companies that are listed that have their operations in Hong Kong, China, or some of the other overseas market, because there is a very well, and I think this was covered. Was it in Financial Times or was somewhere? There is a very well organized rackets of this pumping up these stocks. So I will always be careful where this company
There
of.
is a,
Yeah, go ahead.
sorry, Vivek, there is a documentary called The China Hustle. I encourage
Yeah,
everybody to
no,
watch that, The China Hustle.
that
And
I've seen a while
they
ago.
basically, yeah, and they, I'm sure you have, for the larger audience, I guess. But there is a very systematic way of going public through Cayman Islands and some of those relatively, uh, you know, trusted or trusted jurisdictions for US, and then obviously they route most their entities through there and then register on these exchanges. And I mean, there is no recourse if an investor gets defrauded, so you got to be careful.
Yeah. So from that perspective, I think that's definitely the case. But even let's say companies like Alibaba, etc., the bigger company, you still don't have any recourse because Chinese government, and that is why I'm like, hey, I love Alibaba as a company, but I can't make it as a big part of my portfolio. The Chinese government doesn't allow any foreign investments directly into Chinese companies, uh, something like that. So it's like that if you own Alibaba, like I own Alibaba shares, I don't have any operational control on Alibaba. I could become a 50% owner of Alibaba shares and still have zero control on it. Because when you're buying Alibaba shares or pick like JD, etc., any companies, you're not buying a stake in Alibaba, which is operating e-commerce business in China. You are buying a stake in something called VIE, variable investing. It's variable entity. It's a VIE format. Come on, I covered it long back.
Variable interest something.
Entity, something like that. Yeah. So what all these companies have done, they've created entities in one of these offshore, jurisdictions, variable interest entity, and they are issuing a shares which will trade on par, at a same economic, match the how the Alibaba share gets traded on Chinese stock. Only thing that you have is economic exposure, and this VIE structure under which all these Alibaba ADRs, JD ADRs, all these Chinese ADRs are listed and trade on US exchanges. If Chinese government wishes, they can declare it illegal. So if you're investing in any of these Chinese stocks, you have to be really, really careful, and you have to understand what you are buying into. Okay. When I'm buying Chinese Baba's ticker on my portfolio, all I'm buying is a promise from a VIE that this ticker will basically ADR will trades at that price. I have no operation control on how Alibaba will run its business, even if I become 50% owner of it. Zero protection. That is the case with all the Chinese ADS that are listed. So that's an overarching theme. What I was referring to, like some of these stuff, is one level below, wherein even if you have these type of companies, there is a well-established practice of some of the fund managers, some of the wealthy individuals, how they come together and buy these stocks, generate a price hikes, and how they dump it. There was a great study done, and I forgot, was it Wall Street or Financial Times? When I read this, I'm like, okay, that's why I only stick to very few companies. On China, I have 5 or 6 which I hold, but still make sure that the overall exposure to this Chinese company doesn't become too big part of my portfolio because of that overarching concerns around VIE and all that stuff. And of course, then if you are investing in a Chinese company, you're in bed with CCP, and they can come and close down the business anytime that they want to, which they did in 2021, 2022. Right? They scuttled the whole IP of Alipay. So all those risks are there.
Vivek,
I'm willing to take that risk with a small portion of my portfolio.
so 2008, there was the top consumer electronics company. Sorry, I don't remember the name. But then the government, because they had the wrong sponsor, the government got pissed off at him and they shut him down for for the number 2 company. And also, whatever U.S. companies go to buy, like Amazon bought the 4th largest company, they just shut Amazon and Joyo down. That's what Chinese government does.
Yeah. So if you're operating or investing in Chinese company, you're under the thumb of the government, plain and simple, and be aware of that risk. I'm not saying then you decide how much you want to put the capital in. So when I'm putting capital in, I know that this risk is there. This capital could vanish anytime. That's why I can't make it a bigger part of portfolio. I think we talked about it when I was looking at Alibaba. It's available. If it was, and I think I did make a statement, if it was a US based company, I would have made it as the biggest part of my portfolio. But I just couldn't because of it's based in China and all the other risk. Right? So anyway, so here's the chart from Wall Street around S&P forecast. From current level of 6870, this chart is probably little. Where is S&P right now? I don't know if it is probably not the. Yeah, not too bad, not too far away from 6835. Bank of America says it will be up 33%. Capital Economics says 16%, and everywhere is somewhere in between. I don't see our usual bull Tom Lee. What does he say? Any other big names I'm missing? Vinay, you have a huge list. Well, I think they're all pointing to LinkedIn proof um, posts around these. But anyone else has eh, any other estimates from WASI that stands out? It goes with almost to 8,000. So we could be anywhere. Or maybe we'll have a negative, or we have absolutely no idea.
Well, this is based on the current snapshot of macroeconomics, right?
Yeah.
And in the intervening time, if there are changes to that, which is called a shock, then it will draw down. And so it may not, at the end point, maybe instead of 8,000, it might be 7,000.
Who knows? And uh, last week when we were meeting, I think someone had asked around, this whole yen stuff, right? That BOJ is gonna raid, BOJ hide the interest rates this week. Now they are like 30-year, 40-year high interest rates. And they said, how are we preparing? What happened to the market? I'm like, and markets were up. After that, he's like, we never know how the market's gonna react to it. I think Howard Marks says it beautifully, right? Even if what you predicted is right, what the outcome would be, we still don't know. We can't always be confident of what the outcome would be. This is called second order effects. Right? So what you thought this is gonna happen, this economics number would be, this is the company, uh, if you are talking about earnings, this is how the company will report the earnings, this is how they'll report the guide, etc. Now how the market will react is still up in the air. So we knew that BS is gonna do the interest rate hike. We knew that there is a yen carry trade. We knew that last year August it blew up. We knew that the capital will move. In all these point of, the market should see some weakness, and market was higher. So this is why I love the market, because it's so dynamic. You never know what's gonna happen in the market. So, like you rightly said, this is all based on that day and what their models showed. Week later, things will change. Everything will be up in the air. We have no idea what's going to happen. But the analysts have to come and talk about it.
The analyst predicting 8,000 is one standard deviation from the current level. So it is nothing alarming or anything different. So, they're not making any big estimation or anything different over there.
Looking at one standard deviation for looking at how far back, because I just pulled this.
1 year time period. So
This is
they're
SPX,
saying,
right?
go to analysis and go to the probability analysis, and you'll see that.
Okay, I can look at probability of cone.
Yeah, that's what I'm saying.
The general thing is like S&P over decades goes up 14% per year
Yeah,
average.
so then I'm looking at we are
they're
looking
not,
at 1 year down the line, right? So yeah.
Yeah.
Okay,
so
I
they're
think
not
I've only
predicting
heard
out
about
of
3
size
months.
returns here.
So you don't have the probability analysis and the simulated trades.
And the probability analysis must be done on the returns, i.e. changes from month to month or whatever, rather than on the absolute price levels.
I'm looking.
This is the estimate by the option traders, option programmers.
16.
Oh, you're looking at implied volatility of the SPY.
You can use the SPX also, the same thing.
Yeah, so look at this in April going back here.
There, you are getting there. 365 days, somewhere around that.
December 27. Yeah, 8058. Oh, sorry, 8.
No,
It's sorry.
December
80.
26. Go to December 26.
Oh, I'm 20. Oh, geez, I'm 27. Sorry. 21st August. October, November, December, 8200. 18 December is 80. Yeah, close to 8200.
But they are not talking about the downside.
Downside, we're looking at 6067.
Yeah.
one standard deviation out.
Everybody is giving a beautiful picture that you are going to have at least 3%. It might not be true. Be careful.
Yeah. That's right. Yeah, we can't just depend
Well, I mean,
on
basically, okay, so if you have been through the markets from 1995 through 2000, every single year it delivered 25% or something return per year. And my thinking is, if there's a fundamental underlying secular shift in the economic system, like it is said that AI will bring, then higher returns than normal are expected. That's the way I look at
Well,
it.
are you looking at more than 25% return?
No, I'm just saying that it wouldn't be unusual to, okay, so on the average, S&P is expected to deliver 14% per year with the volatility, something like that. Anyway, so if there's a theme, I mean, what underlying macroeconomic move happening, like internet days, of 5 years of non-stop penetration of internet technology in the world from 95 to 2000. So I wouldn't find it unremarkable if it also increases 30% next year, the S&P. I think it
Oh,
would
If
be expected.
future
good,
is uncertain. I don't even know.
No, I'm
good
not.
for
I'm
you.
not projecting it. I'm
Yeah.
good for you. This is again a remark, like as
So
if it's me. I'm just saying that this is how the economic system in America has evolved over 200 years.
yeah,
There were railroad years. There were when electricity was discovered, things like that. And in all those years, those boom years, the boom meant this.
yeah. And we will. I think
That is what
for
is meant by boom. And
yeah,
correspondingly, there's also bust years when there
and
is.
we have to have this boom and bust for any technology which is actually life changing.
Yeah, again, taking a look at all these analysts' prediction, the 16% is the highest amount that they are talking about. And they know that the technology, AI, and all of those things are already in the works. So why are they not predicting much higher than that?
Yes.
So keep that in mind.
In in
And
2023, every analyst in Wall Street were predicting we're gonna get a recession and markets will come. We were up like 24%. Who cares? Anyway, looking at the long-term historical returns at current P, again, I just share some of the charts which I find interesting. It's not that you should just follow these and make an investing decision. No one knows what's in future. So, hallmarks are talked about this, I think, at length, is going back to the history of the markets ever since they started collecting data. Whenever the forward P of the market is above 23, we have a 0% return for the next decade. It's a lost decade, right? Now I saw this chart coming from Apollo chief economist, which basically puts this in a statistical way. So they did a S&P forward PE and subsequent 10-year annualized returns, right? So at the end of the day, your return is based on what the price that you pay. And if you look at 2022, 23, 23 onwards, this all has been zero or negative, like less than zero. This is what Max was talking about. Today morning, while doing dishes, I put on a YouTube video wherein someone from the host was showing a chart from JP Morgan, which is a similar statistical chart. Maybe they had the same chart and now they put a JP Morgan label. Who knows? I mean, it's not difficult to create this chart. The JP Morgan analyst or their equity strategist team had a similar chart where it talks about if a forward P is of this history of the markets, we never had a 10-year annualized positive return. So remember, this says 10-year annualized returns. Right? So do what you want to do with this. But currently we are having what's S&P forward PE? I think it is above. We are looking at above 25. Anyway, so where is
Forward P is about 23. That's what I heard on a radio show.
Okay, so we are right at there where which is the break-even point of it is about 23.
Right.
There is a lost decade. So that doesn't mean that will not, it doesn't say that it start to degrade from now onwards. Maybe we'll go 20% up, 30% up, and then maybe we'll have 80% crash, 60%, who knows? Or we'll probably not have it. Maybe we'll have an anomaly, etc. But depending on, and what the exercise which I've started to do is basically I got all the returns of S&P 500 from 1928 onwards. Every yearly return, you can go to Ashwa the Modern website and download it. And I'm trying to look at, okay, what if I'm in 1999 or 1996? And then run a scenario of, okay, let's say now next 10 years how the market perform. If market performs similarly, what happens? If I'm in 1999, then what will happen to my portfolio? Again, it's a very crude way, but I just want to make sure I keep enough cash on the sideline to pay my bills in case, I don't know, are we sitting in 1999 or I'm
Vivek,
sitting in 1996? I don't
Well,
know.
one should always have cash. I always keep 5% cash.
Yeah, if I had my W2 income, I wouldn't have worried about it so much. But now I have to start thinking more on the scenarios and see, okay, where will I end up? Right.
Vivek, average PE before 2014 was 13, and now it's 22 or 23.
That's okay. I'm not too, one sec. I need to draw the curtain too much light. That's okay. I'm not too worried about why the PE has changed, because if you look at the constituents of the companies, the big companies that drive the S&P 500, that have changed. The businesses are much more capital efficient. They're much better in generating cash flows. They are much capital light with quotes, because nowadays those are becoming little capital heavy. But so
But Vivek, 10 points average PE. So from 19 whatever to about 100 years, the PE was 13, and now it's 23 for the last 5 years. Isn't that
yeah,
kind of scary?
so I'm not even talking about those 13 different companies. You can't compare the, if you're comparing it, maybe we should compare for last 20 years where the more internet based companies started to come in. That the nature of the businesses and the nature of the companies that form the S&P has changed. So I can't compare with S&P which was loaded with oranges, and now S&P which is loaded with apples, and now trying to figure out, hey, why are these two different? The constituents of S&P has changed. So the argument which I see sometimes on by in media is around, oh, S&P historically has been, no, you just can't compare it. Maybe we can look at last 20 years when we are similar type of companies, and then start looking at it. Is S&P from a PE perspective overvalued? Sure. Then we can have a meaningful discussions around it. But there is no point in discussing S&P, which used to have steel, oil companies as their top holding, versus the S&P, which now have a Googles and the Apples and much different businesses as their top constituents. We are just not talking about the same things.
Oh, another thing, Vivek, is U.S. big tech or U.S. investors still think the U.S. is going to beat China. When I tell them in Shanghai, which is not Shenzhen, I was able to or I was I didn't was refusing to use the latest IT. So in China, they're using public works to use the latest IT. I never got onto WeChat Pay or Alipay, but I would have starved if I was there during the lockdowns. But what I'm saying is, here we still use a checking system and the money order system, and the government doesn't really adapt to the latest tech.
Government, I would rather have government stay out of it, and incumbents, they will get disrupted.
Well,
But
Vivek,
if you have an incumbents, the growth is always slower, and that's the issue, that we have a big incumbents here with the banks and all that, and they will try to um, you know slow
Vivek,
down.
we had LED street lights in 2017, and in 2016, my friend was working as a CFO for a California startup company in Shanghai for LED lights. It's these things we want the latest, a better, more efficient. That's what I'm saying.
Yeah, building something fresh, hopefully, will build it with the latest tech. Rip and replacement is always difficult. And we have seen doing a professional, especially on the software, and fixing the code is always the tech debt is always painful. Rather you build afresh, you'll probably build directly on AWS. But if you
And
have a
another
tech
thing is
of
the only thing you San Francisco Bay Area has is new is electrified Caltrans, and that doesn't even help the whole bay, and that's not even new. I rode the high speed rail in 2011.
yeah, let's not even talk about public transport here in US. It's worse. All right, coming to some of the other some innovation that is happening at least, and which is now Coinbase, crypto exchange is now becoming full financial services company. They expanded their offerings to prediction market, stock trading, equity, perps and futures, perpetuals, full text integration, borrowing against your assets, Bitcoin, Ethereum assets, new payment advisor. So essentially, Coinbase is becoming Robinhood. Robinhood is doing crypto. Robinhood is becoming Coinbase, and all of them are now becoming banking services. So there is, I think, few years down the line, we'll all just talk about financial service. There is no crypto or versus crypto fi or TradFi. Right? It's just gonna be one service which is, hey, this. I mean, today we talk about crypto and non-crypto, traditional as a two separate ones. They're gonna get merged together eventually, and I don't know where that leaves SoFi, because that's again one of our favorite retail stocks. I see SoFi being discussed a lot during on Twitter or on X. It's not Twitter anymore, it's X. But yeah, these all gonna become a big financial services that they all once wanted to disrupt. Today morning, I saw another fintech company, banking as a service company called Mercury. They filed charter to become a full chartered regulated bank. I mean, these guys wanted to. They started with all this bad software and saying the banks are slow, they are regulated, they can't move fast. So hence we are the new, tech company. We are the disruptors. Now the disruptors are becoming the old regulated banks. So eventually, I guess everyone will become a financial services company, and you could. And on the other side, we have seen the traditional banks moving into crypto space with PNC. I think PNC and Coinbase. Last week I shared they joined hands together to offer their customers that they can buy Bitcoin from your banking interface directly. Now with OCC and Fed giving green light to these financial institutions to start play with in the crypto assets, this is bound. I mean, sooner or later this will happen. So I'm not surprised that both Robinhood and crypto, Robinhood and Coinbase, and on the other side the traditional banks, they're all gonna 10 years later they all look the same. If they don't, then some of them will just die down. Okay, so I think there's a 90 minutes video. I'll just put in a link where they introduce a lot of these features. We're gonna go, you can look at it. Asif says, while looking at a coin versus Hood, to my surprise, coin has done much better in terms of revenue growth. Okay. Coin is creating alternative for crypto holders. When it crashes, they panic sell. Now they can buy the stock right here. Now, if and then the stock crash, they'll panic sell that too. I don't know. Nasdaq wants to become round the clock. Yes, it is 24 by. I think it's going to be 23 by 5. You'll have a 1 hour of bio break, and then 23 5 by 5 Nasdaq will be. Again, it depends on how much is the liquidity will be there. Do you even want to play in that or not? Crypto has been 24 by 7, right? But when there are some degenerates who want to trade continuously on crypto exchanges, sure, go ahead, do it. Nasdaq wants to cater to the crowd that wants to stay glued to your screen, sure. Or it will be useful for those who trade on Nasdaq but are outside the US time zone, right? You'll have to put your own boundaries. uh it is now becoming like 24 by 7 office is open. You have to put your own boundaries. Okay, I'm going to work only from this time to this time. After that, my phone and the laptop is stashed. I don't want to look at it. It will be difficult. Emotionally, it's going to become more challenging. But I have nothing to do with it. I'm saying it right now. I don't know once, starts to happen and figure a much bigger liquidity at that point of a time. We'll have to see how liquid the market is during so-called overnight hours. We'll skip this and now look at let's maybe look at the portfolio metrics, then we'll jump onto the learning from the mistakes of great investors. So a few of the metrics that I started to put together, and well, I'll track for my own portfolio. Now we should have a discussion on what else we can track. Is of course best and worst month. So I have my trading accounts, which is non-retirement accounts on which I trade options. Then I have my retirement accounts, which is mostly I don't do too much on it. So there are a few things which I trade track for my, when I say option metric, these are all my non-retirement accounts on which I have options enabled, and I regularly trade on this. Is best and worst month, right? In terms of return, which month had the biggest gain or the worst loss? Okay, high, what's the overall high? Which day? What's the max drawdown? Right, I had in my trading portfolio. What's the max daily change up or daily change down? Probably could be close to the liberation. I think the daily change up will be after the liberation day. I think it was 9th, where the market went up. Anyway, win-loss trade also in terms of how many trades, what's the percentage of win, percent of loss. Option trades they held, for how long have I held my option trades? Now this could include all strategies, or it could be a strategy specific. Hey, if I'm looking at a hedging trades, because hedging I will do it like weekly wise. How long did I even held those trades, right? On an average of all the trades. Unique triggers, that's fine. Percent of profitable tickers, net option premium earned on each ticker, top 10 profitable strategies in terms of the dollar value. Total number of strategies versus the trades, how much I did where. Top 20 tickers ranked by dollar value of option premium. Basically, top 20 tickers, top 20 profitable tickers when it comes to the options. I don't know, what was the days analysis I looked at? I think this is how many days did I trade? How many of them were profitable days? How many of them were losing days? Right? What's my median daily income in terms of which will basically be total option income for the year? Look at daily basis and see on what's my median income, what's my average one, max income day, max loss day. This is all related to the option trades. What else? Buying power use, very important in terms of overall, which tells me how much have I exposed myself in case of a market goes crashing drawdowns, etc., do I run into a risk of, you know, margin calls, etc., right? So I want to look at, and I track this buying power at end of every month. I'll see how much of buying power I've consumed. So for every month, I'll have a list of it. And then finally, the portfolio volatility is basically I have a long chart from day one all the way till the end of a year, and you can look at it, okay, daily profitability. Do I see a big spike? And right now, I do see a spike both on the downwards, which is on the Liberation Day, and then huge spike on the up direction, which is on again just right after the Liberation Day, the 9th of April. I also download the data of S&P change on every day basis. Then I basically plot it against and see, okay, how was S&P doing that time? Some of the stuff that I just do want to look at it. Again, overall portfolio, which includes the retirement account. I don't know. Does anyone have retirement accounts with Fidelity? Can you get your daily net liquidity value? I've never asked them. So for my trading accounts, which is with Schwab and with Tastyworks, I have access to get the daily account balance, right? Which drive a lot of these stuffs like portfolio volatility. I can get from there because I know at the end of the day what my balance was in these accounts. I just never try to look for it in for my 401ks. So for 401k, it's like end of a month. I have those statements, so I know what's my best and worst month. Maybe do your YTD gains, overall portfolio, maybe performance under overperformance with respect to benchmark. Probably that also that also goes for the trading accounts as well. What else? What else do you track? Something which is you think we should be tracking and is completely missing here. I know one thing which I used to track, which I stopped tracking anymore. Let's say you guys can find it out. Which many fund managers do track.
Hey Vivek,
Yeah.
I personally track like what my projected um percent return per week or per month. That way I can see like, okay, like if I'm more of a frequent trader or monthly trader, I'll say, okay, if I want to say make 20% a year or 10% a month, whatever it is, I'll have the projector on like one column that, so that it's more like, if I were to compound this type of results over a year or 2 years, I can see what path I'm on. And then I see what my actual results are per day or per week or per month. And that way I can see, okay, if I were to do this consistently, okay, am I behind? Am I ahead? So I like to track my portfolio that way, like what my projected, whatever my rate of return I want versus what my realize is.
Okay. So I kind of do it on the end of a month basis. I know I do it on a daily side, but at the end of a month, I take the balances and see, okay, what's my year-to-date performance has been. And then if we annualize it, I know if I continue on the same path, the annualized performance will be this. I guess.
Yeah.
Yeah.
So I guess what I mean was like have a target goal. It helps me kind of like keep my eye on the big picture. Like,
Okay.
okay, this is my target. Okay, am I trailing it? Am I behind it? And it kind of makes me, just to make sure that I'm in the right risk parameters. Am I achieving my target? Like because I'm a big proponent of if you don't know specifically, SMART goals, right? You have to be measurable,
Yeah.
attainable, all that stuff. So I create a goal and say, okay, is this a SMART goal? Okay, is this realistic? And then I look at my performance. And if it's not, then I gotta readjust my goals or whatnot. But it just helps me keep track more detailed. Like, okay, what am I doing?
Yeah. I don't start with a goal, but that's just me. I don't start with, okay, I have to make 20% this year. But I do track what I'm making. But I don't start with the goal.
Actually, you're right. Like with a bigger account, like an IRA, or like if you're trying to do it for a living, it's probably harder. But maybe if you do it like a smaller account that you have maybe like 10,000, 20,000, and you're like, okay, I'm gonna try to grow this, maybe more aggressive goals. Maybe that's what I do it more for.
Yeah,
Yeah,
sure,
my
sure. Yeah. So it's not wrong. That's just that I'm not doing it. Okay. How to measure this? No, I measure it myself. Asset class split, overall portfolio plus return asset class. So asset class split, I have it on monthly basis. Yeah, I don't do it every year, like end of year, but maybe I can have an end of a month. I know let's say, what do I asset class? Stocks, bonds, cash. These are the three assets that I track. I also look at in terms of my country exposure. Which country I have what exposure. But that I have my date, like monthly data I have against each of the stocks that I've listed, and then I know this stock, US based or China based, etc.
Vivek, the buying power changes from day to day. Which number are you using
End
for
of a
the
month.
buying
End
power?
of a month.
Okay, that does
So
not
so my
really
end of
help you.
yeah, so end of a month is like my generally an activity because I'll go and look at my toss, how much is the current buying power, and I'll use it. Yes, it
Yeah,
doesn't help
and
me
again,
exactly.
if you use it at the third week of every month, it's going to be the best buying power effect that you can see in there. I mean, you're essentially the options are expiring or something of that nature. So you might see less of the buying power used, but in between the time period, you will have a significant changes in the buying power, uh, based upon the movement of the stock underlying.
Yeah, could be, but I think I had to make a call between how much of
I
overhead I do.
understand, but
Yeah,
that is not that's not possible for you to monitor those things, that buying power used.
yeah,
You can get an idea, but it is not really the
correct.
on the regular time basis.
Yeah. So I just want to make sure I'm not using too much of it. At end of a month, I'll go and just look at it how much of buying power I've consumed. So I know now if I look at for this year and I'll look at, let's say April will come out, let's say end of April month, and I know that, oh, come on. Mid of April, probably I had used another 5-10% more than what it is currently showing. But it'll give me an idea of, okay, that is still within my parameters or not. That's the only stuff.
Yeah, sounds good.
Okay. Anything else? No one talked about Sharpe ratio?
Drawdowns.
Drawdowns I have.
Okay.
So I have a drawdowns. I have, okay, how many new highs did I have? Account highs. What's my max drawdown? Sharpe ratio, I don't do anymore. I used to do Sharpe ratio earlier. I've ditched that. Because that's, me personally, I don't think that's a indicative of risk, because traditionally, if you look at from a Wall Street side, volatility is risk. I am starting to move away from that concept, that volatility is risk. So earlier I used to subscribe to that, saying volatility is risk, and hence I used to track Sharpe ratio, and I've stopped tracking Sharpe ratio. Because that's one thing which people will ask you. Moment you say, okay, what's your Sharpe ratio? And I'm like, now I'm not doing it anymore. Cool. All right. Let's yeah.
I have one question.
Yeah.
So basically, do you just export the account statement from thinkorswim and do these numbers in Excel?
That is correct.
Right. And that view gives you enough information to calculate all these metrics. Or
No,
do you
so
have
for individual stocks, if you look at for option trades, etc., so that I journal my trade, right? Like if you look at my website, for every trade that I do,
right?
I journal it, so I know exactly my option numbers will be. Now, when it comes to the other stuff around the account balances, etc., I just look at account balance at the end of a month. But all these stuff, because I journal my trades, and then I have the data available. I can create whatever view I want to from the data, or whatever analysis I want to from my data.
Do you have a max risk per trade that you abide by?
At the back of my mind, I used to have it when my portfolio was smaller, and not think about it too much, because now I know that I don't do big trades anyway. So it's a number that I could track it, but it's more of an academic exercise, because I've become a lot more conservative in terms of my buying power. Now my portfolio is much bigger. So like $5,000 max risk per trade probably won't make, or 10,000 doesn't make too much of a difference. So I've stopped tracking max risk per trade. But do I put in, when I do journal my option trade, do I put in what's my, the max risk on it or the buying power consumed? Yes.
I'm just curious. Like let's say like an event happens, and let's say we have a big drawdown, or the market, who knows, actually
We
becomes a
had
bear
drawdown, right?
market.
We had drawdown. It's not theoretical exercise. We had drawdown in Liberation Week.
Yeah. It's like, how do you manage, how would you advise, like, okay, the portfolio, because we've been in such a bull market, but what happens if, like, all of a sudden, boom, something hits? Like, how do you approach that? Like, do you just, like, does your portfolio just take a big hit and you just kind of suck it up and kind of like, how do you take that type of
No,
situation?
so first is I don't want to be margin called away. So that's why I keep a very close eye on where my buying power is. And I also stay conservative. So when
Yeah.
the market crashed 34% in COVID, I didn't have to lose sleep because I had enough buying power still available in my account. So I got zero margin calls, nothing else, right? Now when the market corrected 34%, some of the hedges, they minted money for me, but you're still down. So now I could start selling calls and reduce the risk, and do the regular stuff, right? But keep an eye on in terms of how much of your buying power you've already consumed. That
Mm.
has helped me in going through these drawdowns. We had what, 22% drawdown during Liberation Week. Fine, the portfolio does get a hit, but then you continuously reduce your delta. At end of the day, I think it's a game of how much bullishness you want to have in your portfolio. If you are too bullish, then if the market goes against you, you are hurt more. I'm never too bullish. So I would always have some of my hedging trades available in case the market goes down. Yeah, our portfolio will still go down, but at least not as much as if I did not have those hedges.
What type of hedges do you
I
do?
sell I sell naked calls against QQQ, SPY, XSP.
Okay, so naked calls.
Yeah, or covered calls against my own. I don't know covered calls as hedges, but mostly at the portfolio level is the calls on these broad market indices.
Mm. Would you ever short like futures or anything like that?
I don't know. I'm not on futures.
Okay.
Yeah, you could do futures because they'll give you a lot more bigger value. The numbers, the notional value is higher. I just haven't tried futures. So I can get my work done through this indices
Yep.
or indices ETFs itself. Okay. The idea is to figure out what works for you. You shouldn't be taken out of the market if the market crashed 30%, 40%.
No,
And that is
I
why I'm okay to stay conservative and not use everything that I have available in the arsenal when market is bull. I never know when the market will turn around.
On your portfolio, do you have positions based on different time frames, like more longer term versus more like monthly or weekly? Like, do you have time frames of your portfolio?
My hedges will be on a week-to-week basis. Every week, next 3 weeks, I'll have short calls on some of these. Some of the tickers which are liquid on the weekly basis. Now, because I can afford to do weeklies. When I was working, I never could afford to do weeklies because they need a lot more monitoring. I have IBIT, which I'll do on a weekly basis. There are a few tickers I'll do weekly basis. Otherwise, most of my option trades will be on a monthly expiration cycle. So right now, it's all January monthly expiration. I thought I'll start with the February trades, but not started this week. Maybe next week I'll start with February trades.
Got it. Thank you.
All right, cool. All right, last one. Let's talk about the learning from the mistakes of a great investor. So I read through the book, then I had my summary, and then I fed the summary to this LLM. I was blown away by what these LLMs can do. Right from a textual summary, I think I use Notebook LM, asked it to create a slide deck for me, and this is where the real what called productivity of these models shows up. Let's go through this. Thank you to Google and Notebook LM for this for the slide deck that it created. Basically, learning from the mistakes of greatest investors. All investors say the same stuff. The enemy is within. Investing is difficult not because of intellectual, but because of psychological treachery. I actually have not read each words. Hopefully, they are all right. Right? We talked about many times. It's more EQ game than the IQ game. Then they talked about some of the biases that we have, right? Attribution bias. Earlier we were talking about it. We credit our success to our own skill, but blame failure on bad luck. Endowment effect. And there have been studies done on it. The moment I own a share, it becomes a lot more valuable to me. Just more than a minute ago before I owned that share. Third is a behavior gap, which is way more important. Even if you invest in S&P 500, S&P will do 10%, and investors in an S&P still getting only 7%. Why this gap is called behavior gap? Because we just move in and out of it. Even if the underlying instrument has delivered X%, we always earn less than X%. All these are because of our own behavior. It's nothing to do with IQ. Swan can give you the best stock, Apple in 19 whatever, pick up 2000. We still wouldn't have been able to stay with it because of our own psychological build-up. Now let's talk about the big mistakes, and this has done a good job of categorizing it. So let's first big mistakes of investors, which are like mostly driven by hubris or illusion of control. This is where the skill versus luck comes in. Don't confuse brains with the bull market. 2021, everyone was Warren Buffett because market was going up. I thought, oh, I got lucky. I could identify all those such growth companies, and I did. Well, until I realized how stupid I was. Because market is going up, then we think, oh, it's all because I'm smart. Definitely not the case. And we are not the only one, right? Long-term capital management. Who heard about long-term capital management? LTCM. Those who have been in the market for way longer than I have probably know about LTCM.
I've heard of it.
Yeah, it caused a big 20%, almost 19% drawdown in the S&P in August 1998. It was because of these people cornering so much of the investable capital that when they crashed, the Fed had to come in and bail out.
Yep. So John Merriweather came from Salomon Brothers, very successful traders. And of course, after the Salomon got implicated in rigging the treasury purchase, etc., moved out, formed a new team, got the best academic minds, best IQ people, right? They had a team of Nobel laureates and the PhDs with more IQ points per square foot than any other institution in the world. So those who trade options, I've heard of Black-Scholes, right? Both of them were part of his team, Robert Burton and I think Black-Scholes. There were three people who were involved in this forming this equation. No, not the equation, this option value calculation, right? They got Nobel Prize for it. Two of them were um, in his team in LTCM. He got PhDs from Harvard's and MIT's to be part of his team. They built fantastic models which could predict to the seventh decimal of how the risk, etc., and how the markets would behave, and they could control their risk. They believed their model could predict what could happen in the market because these guys knew their stuff. But no one can predict the market. They did a big bet on they had a big trade on the Russian ruble bonds, and the Russian government chose to default.
No, the trade was actually what's called basis trade between the long rate and short rate. And essentially, the lesson is that they were too leveraged. Look at
Yeah,
so basically, it's the same lesson in futures market. 90% of the people who play in the futures market will end up broke. Or another, they'll have to end with nothing in hand. So that's the same lesson. Don't lever up too much. That's
yeah.
it.
So
And the Russian bond default caused the shock that I was
exactly.
referring to earlier, which rippled through to the US Treasury market, upsetting the damn basis trade because the basis trade was reliant on the fact that 99% of the time it will not be upset.
Yep. So I think you got it exactly right. So Russian ruble, when the government defaulted it, decided to default on their bonds, it upset their trade, and they were at some point of time they were levered like 100:1 with
Yes, 100
1.25
is one.
trillion.
That's right. Yep.
Anyway, so they lost 550 million single day, and then the fund was down 52%, as Kevin mentioned. Fed has to step in and they have to bail this out. Again, hubris. We are Nobel laureates, we know exactly how the models work, and then they levered up. The other one is a study of Jerry Tsai and the Manhattan Fund. I never heard about this. I read this book, and Jerry Tsai was a market star who was with Fidelity, and that fund returned almost 300% from 58 to 65. But they used to do a lot of a turnover. They had a huge turnover for almost 100% turnover on their fund. So he basically moved out, started his own fund called Manhattan Fund. But this is where you confuse the bull market with brains is he didn't realize that all like the huge gains that he had was because the market also had a bullish tail during those years, right? So he was basically playing in the bowling alley, with the bumpers on.
That's very funny.
Not,
Yeah, that's exactly how I get high score when I bowl with bumpers.
yeah, and doesn't really matter how hard you hit, right? You're gonna come back in the market and gonna probably, throw some of the pins around. But if you take those bumpers out, then you really know what your skill is. And when they started Manhattan Fund, and when the markets turned around, it lost 90% of its asset, and it had the worst 8-year performance in the mutual fund history. Again, don't confuse brains with the bull market. Right now, or let's say, given what has happened in last 3 years, 2023, 2024, now 2025, bumpers are on.
Well, I think the comment there is that you have to always benchmark against what your active fund stuff against the benchmark. So if the benchmark has gone up 25% since June, and you are close to that, it's okay. So I don't think unless your focus is that the S&P 500 is going to retreat, you don't say that, hey, I'm going to be looking more at risk now versus 6 months ago.
So easier said than done. Looks like these star fund managers probably don't do the same stuff.
No, they had no risk management. There's an official discipline called risk management at all banks and financial firms, which wasn't there in the 60s, 70s, even 80s. A lot of
Yeah.
companies.
All right, so two lessons. Jerry Saif, John Merriweather, LTCM. I think there's a whole book on LTCM. I need to read that book to get in the detail. Second is around conviction and echo chamber, right? So lesson, Benjamin Graham, lesson learned from the guru of investing, teacher of Warren Buffett. Even he had to learn his lessons. So, so as we know, Benjamin Graham, the father of value investing, completely focused on buying the companies at cheap prices or so-called value investing, right? And believing when the market started to crash, corrected in 1929, it wasn't until I think 1932 until the market actually bottomed out. And then when Graham looked at, oh, the prices has fallen, it looks cheap based on relatively PE basis, etc. And he started loading up on his fund, but market wasn't done yet. So his fund itself lost 70%. Right. So the lesson was a falling price might not equate a better value.
That's what happened to Steve Miller in the Miller funds in 2008.
Okay,
And
that has not been covered in the book. So really interesting story on Steve Miller. So and Graham, actually, I was looking at like bigger notes, the summary which I gave, and I mean, obviously didn't put all the content. I'm looking at that. Graham began his $450,000 portfolio, which became 2.5 million in 3 years. In investing mistake was 1930. He thought worst was over. He went all in and used margin to leverage the expected returns. The worst was not over and he lost like 70% by 1932. First he went all in, then he also leveraged. And even
they allowed 10%, 90% margin.
yes, that I saw in 1929 book that you can only put 10% and get 90% margin. Those are like wild west days of investing.
That's where after that the SEC stepped in and said no more than 50% margin
Yeah.
available.
Okay, the next one, Jesse Livermore. If you're a day trader or speculator, you would have definitely known this guy. This has been like his 1929 fame, big speculator and also a short seller. And he made, of all the stories around 1929, he was the one successful story. He made $100 million when the market crashed in 1929. And when I was reading the book of 1929, interesting story, when he went to his house, he saw his wife was not there at his house. And he went around, looked into all bedrooms, couldn't find where his wife is, and kids are not there. Then he went to, I don't know what the real name is, like a side house or a barn or etc. He went there. There he saw his wife was like huddled and hiding on a corner in a space. And like, what happened? And his wife says that I heard that the market has crashed. So she picked up her jewelry and whatever cash she had, put in a box, and she went and hid herself in thinking that we are done. And he told, honey, I made $100 million because he was short in the market, right? And he made $100 million in during that 1929. But afterwards, bottom he made $100 million. Afterward, he still stayed short because that's what once he made money by being short, he still stayed short. And when the market started to rally up from 1932 towards 1933 and all that stuff, he didn't. Uh, he was still on the. Oh, let me go through it. He
That happened
stayed
to me.
short, and the after the initial short, market bounced back 93% in 42 days, and was still short. So he got crushed because then he had to cover his shorts. And then when he covered his shorts, he thought the worst is over. He went long at the top, but the market did not finish correction until 1933, and then market fell down another 40% from 32 to 33. So he got cut on both sides. After he made initial $100 million in the crash, stayed short, market bounced 93% up, call it bear market bounce or dead cat bounce. He stayed short, lost money there, covered it, went long, leveraged, and then the market corrected.
So there's a
This
song, the gambler song. You need to know when to fold and when to walk away. The walk away part, you forgot.
He says my position was right, but my play was wrong. He is the most quoted trader of all time, which exhibited the poor risk management. And eventually, I think of 2 or 3 years later, he took his own life because he lost everything.
Yeah.
Yeah, this is why the whole this day trading stuff, it's very heavy. Not everyone's cup of tea. Third one is Bill Ackman. This is, hey, I've seen this. I've lived through this. Right? There's a documentary on Netflix, Betting on Zero, I guess, which is basically the whole um, story around how Bill Ackman went around the investing world talking about how Herbalife is a pyramid scheme company and basically was short on Herbalife. Nothing wrong in going short, right? But the problem that he did was he was became a crusader, not gone short, but went public with that information, went on all the media channels with that information. Basically, he put a bull's eye target on his back. Now, Wall Street is dog eat dog world, right? And now you can go and to the interviews, etc. What happened, right? So when he declared that he's got $1 billion short position on Herbalife, Carl Icahn came in, talked about it. He has got a long position. I think David Einhorn came in, David Einhorn and some other fund manager came in with a long position. He fought tooth and nail against that. Stock continued to go higher. SEC did some investigations and all that stuff, but eventually I think he lost 4 billion on that trade before he closed. Pershing Square manager. Bill Ackman, very well respected. Mistake that he did was he forgot why he was in that trade. He was in that trade to make money. But he forgot that, and basically his ego got better of him because now it's publicly declared that I'm short on it. He stuck to it, couldn't admit his mistake or couldn't close his position once retired to lose it because it's gone, um, you know, he's declared his position so wide and open to the rest of the world. He just couldn't let, you know,
He went into.
probably couldn't close and admit defeat because that would have been a blow to his ego.
So this is the same stuff which is called the Reddit apes causing short squeezes, like it happened to GME 2 years ago. GameStop
Yeah.
stock.
Yeah, the Melvin Capital.
Yeah, one company was completely driven out of business.
Yeah, that's why I don't do that's why I don't do short stock because never know. Stupid company, but anything nowadays anything can go high.
Didn't Robinhood and Ken Griffin like they kind of rigged the market so that people couldn't buy it?
Yeah, that's a conspiracy theorists say that they rigged the market, people couldn't buy it. Robinhood,
The-
Rob, the stories I don't know who you should believe it.
So I was doing that GME thing on some days. This TD Ameritrade would basically say you cannot borrow this stock anymore. So those kind of things were happening.
Yeah,
Uh,
and you could.
to
I read
short.
somewhere that you couldn't even buy the stock because
Yeah.
they're taken off the. You could only sell the stock. It is because the regulators wanted Robinhood to put more capital so that if the Robinhood traders cannot honor their commitment, then they still need money to OCC is basically make sure that whatever trades you're putting in, you know, will get will reach its the desired conclusion, right? So they asked Robinhood to put in capital. I think Robinhood got a demand for some $3 billion of a capital overnight.
Right.
See, unless you can put in capital, you cannot have more open positions, new positions open on these tickers. So they had to arrange for liquidity injection into the market to satisfy the regulators' needs. Otherwise, regulators would have shut Robinhood down. That's a Robinhood side of the story, saying that we got a call saying we need to put in more capital because more and more risk was involved in that trade. And if we were active during that time, we would have seen the higher the GMA stock goes,
Mhm.
the higher the implied volatility was going because the risk was on the upside, which is very different than the normal stocks where the risk is on the downside.
Right, that's the gamma squeeze concept, right? Basically, you're squeezing the stock and driving its gamma higher
So,
such that delta hedgers are forced to buy more. And
so
what's the meaning of higher gamma? It's basically higher delta, which means higher volatility.
yeah, not there was a gamma squeeze that was done, but let's talk about that later.
Okay.
But even on commodities, the risk is on the upside. So even if you see gold or silver, probably even if there is no gamma squeeze, but the IV goes higher generally when the price goes higher.
Oh, that's the expectation of the future is that it'll be more volatile, right?
Exactly. Yeah. So anyway, so coming back to this, yeah. So Bill Ackman, big mistake that Bill Ackman did was it became a personal battle rather than he forgot that I'm in this market to make money. So never take it too personally. So, or don't advertise your positions if you are,
They have to in order to drive it down. That's what all these short people's thesis is, right?
or yeah, or just don't advertise your positions too much if you cannot, stomach if your position goes down. Anyway, so that's what happened with Bill Ackman. Let's talk about other one, right? Someone who made big.
I know him.
They were basking in the victory shadow. John Paulson made good amount of money during the 2007-2008 crash, right?
Mhm.
His fund gained almost 600%. Immediately, he went for his next multi-thousand return, put $5 billion in gold in 2010, right? And then we know from 2011 till 2022, gold did nothing. And gold actually started go down after 2010. And it only recovered back to its peak in 2022. I hope John Paulson kept his position because now after 2022, last 2-3 years, gold has done wonderfully. Right? So sometimes the money earned by luck is indistinguishable by money earned by skill. So you were great on one trade doesn't really mean that you can just apply the same skills as somewhere else. There was one more case study of another person. I don't know if that is covered in this or not. Probably yes. Okay. The next one is Stan Druckenmiller, right? He is, I think, the only fund manager that we talk about had never had a losing year in his 30-year long career. I mean, his career is longer than it, but the fund that he runs, he never had a losing year. But he talks, he is very open. I love when he talks about this, his own biggest mistake. Stan Druckenmiller became very famous when he and George Soros basically broke the British banks, right? The British pound. That's in the those who trade currencies, etc. Right? Probably it's a case study of how they did it and how big the position that George Soros wanted him to take. And basically that was a trade of a lifetime. But in 1999, right? He was when he looked at in during the dot-com bubble. Let me go back to the little more detail around what happened. So in 1999, during the dot-com bubble, uh, he bet against some of the stocks that he thought was overvalued, internet stocks, and some of them corrected. So he made a couple of $100 million. But then afterwards, the stock continued to go high. And he saw some of these young traders like making money hand over fist, right? So he was like, how come all of them are making money, right? And some of these short bets that he had that were going against him, and he was down like almost $600 million on that. And then he's saying, gosh, everyone else is making money, even though his thesis was that these companies are way overvalued. Just that his emotional, um, call it wake up or call it ego, got better of him, because he just couldn't fathom that these new young traders that they recently hired are made millions and millions of dollars, and he is such an accomplished trader, and he's losing money. So he put in, I'm just looking at the number, he bought 6 billion worth of tech stocks. And if you listen to his interview, he says that maybe I missed the top just by an hour or two. And in 3 weeks or 6 weeks, he lost 3 billion of it. And people ask me, what's the lesson that you learned from this? He said, I didn't learn any lesson because I knew what I was doing was stupid, but I just couldn't see the other, traders make money. I just couldn't help myself. There's nothing new that I learned about the internet or the economy or the company. I knew those were shitty companies. I knew that these were highly overvalued. I knew that we shouldn't be doing it. And I did it. And he lost $3 billion. After that, he took a little bit of sabbatical. He says it was very difficult for him to cope up with that big loss, knowing that he was right, and then he still lost it because emotionally he couldn't control himself. Right? So again, even the greats like Stan Druckenmiller are, can become victim of these emotional mistakes. So you and I are nothing, right? It's all. Other one, Michael Steinhardt. Again, he was a master of small and medium cap stocks, had a great career, unblemished career, for returning 24.5% for 26 years. But what happens if you have such a great returns? Your fund starts to grow bigger and bigger and bigger and bigger. Now, your expertise in small and medium stocks, there are not many small and medium companies where you can deploy such big amount of capital. So he started looking for other opportunities, international currencies, areas which were outside of his core competency. And then 1994, he had a huge drawdown of almost $800 million. Huge drawdown, which was like the big black spot on his 26-year career. Again, the whole idea was don't move out from your core competencies. So I'm a big fan of where Warren Buffett said, this is too hard pile for me, and don't want to invest in it. He had no business in moving into bonds and currencies. That wasn't his area of expertise, but he did. Ended up losing $800 million. The another one is Sequoia Fund, Bill Ruane, who was the guy when Warren Buffett closed his partnership. He told all of his customers that if you want my advice on who should be managing your money, you should go to Bill Ruane. Great investor, managed Sequoia Fund, great returns, right? But then moved straight away from how he built up his portfolio and went too concentrated in Well and Pharma. And then one big bet caused, huge drawdown on his Sequoia fund. It was like fund was down from 9 billion to just $5 billion. Again, very successful um, investor, strayed too far out and became too concentrated. That's why I'm a big fan of maybe let's keep 25 stocks. I don't know. Today, Google looks great. We don't know what the future will hold 10 years down the line, 20 years down the line. One person that we all know, someone who's stuck with his core competency, is Warren Buffett, right? Even if Berkshire Hathaway fell 51% during 2000, he's still stuck to his lane, which is right. I mean, I don't understand tech. I'm not going to invest in tech. That's why I don't do individual biotech companies. I don't care how attractive that is. That's the area where I have zero expertise on. Not that I have expertise in any area. I'm more of a dabbler, but that's completely out of my circle of competency. The reason I didn't invest in Arista Networks for so many, I mean, I've heard Arista Network in 2020 because networking is one area where, while I was working in the tech sector, I always stayed away from it. I can't wrap my head around it. So it took me a lot of time to understand a little bit of the networking side before I could take a position in Arista. Yeah, I missed a lot of gains. That's okay. Stay within your circle of competence. I think that's it, I guess. Yeah, and finally, the mistakes are the tuition. We will all pay the tuition fee, and I have paid tuition fee. Each of these great investors have paid tuition fee. There are more investors than mentioned in this deck. I don't think it talked about um, Mark Twain. We have not talked about John Maynard Keynes, Chris Sacca, even Charlie Munger, right? So even they lost money. So we all of us will pay tuition fee to the market, but if we can learn from mistakes of other and try to be cognizant of, hey, am I, like Kevin said, right? Am I bowling with bumpers on? Or is it my skill? Or is the market just going high? Or am I just changing some of the growth stocks? It helps. It will help in the long term. That's all I want to say. I think someone asked what's the name of the book. Bobby, the name of the book is Big Mistakes by Michael Batnick. He is the author. Michael Batnick, name of the book is Big Mistake. It's a very easy read. So yeah, could be on your holiday reading bookshelf. But I enjoyed reading this book. And Notebook LMS made it a lot more better than I could have ever done in terms of the deck. All right, that brings us to the end of today's discussion, guys.